This problem gives us an income statement and some balance sheet information and asks us to prepare a schedule calculating cost of goods manufactured, and then asks us to prepare the cost of goods sold, income statement for the period of August, because this income statement is incorrect. It doesn't have a cost of goods sold section. So the income statement provided here is incorrect. So when we look at this, this is a manufacturing company. Since it's a manufacturing company, we should be putting some of these expenses into inventory. And the expenses we need to be looking here, separate out, the ones we have to separate out of these are the product costs. So some of these are product costs and some of them are period costs. So the first thing we want to take out are the items that should be put into raw materials or direct materials. So this raw materials purchase, that should be reported as a component of raw materials inventory, or it will be treated as direct materials cost as we are producing inventory. The next item that we see in this income statement that is incorrect would be the direct labor costs. That would be treated as factory labor or direct labor, and that's going to be a component of the manufactured products. So that would be a component of our inventory as well. Then the third thing that's product cost would be manufacturing overhead. So items that are associated with the factory would also be included in inventory. So rent on factory facilities would be a manufacturing overhead item. Depreciation expense on factory equipment would be a manufacturing overhead. And indirect labor cost would be a manufacturing overhead item. Now, there could be some additional things here. So for example, utilities and insurance expense, there could be a portion of those that would be manufacturing overhead, but I don't have enough information at this point to determine how much of those would be part of the product costs. Advertising expense, selling and administrative salaries, depreciation on sales equipment, those would be period costs, and as such they would remain operating expenses, so they should stay on the income statement as they are. So this net loss is going to become smaller, or actually turn into a profit, because these costs that are in the boxes will be removed and become part of inventory, because they're being used to produce product that isn't necessarily sold in the current period. So when we go forward to the next section, prior to August of 2017, the company had been profitable in every month. And this is why we're looking at this, because there's probably something wrong. And we find out that we had inventory balances. Raw materials at the beginning of August was 19,000, end of August was 35,000. We had a work in process balance of 25,000, ending balance of 21,000. Finished goods of 40,000, finished goods ending of 52,000. So we'll be using these numbers when we do our cost of goods manufactured schedule. And this is the big takeaway from this problem, because you will be asked to do one of these on the test. They do give us the extra information that 60% of the utilities expense is going to be charged to manufacturing overhead. So $6,000 of that utility expense is going to go to manufacturing overhead, which means $4,000 would be treated as a period expense, and 70% of the insurance expense, or $3,500, will be treated as a manufacturing overhead expense. So the $1,500 remaining would be treated as a period expense. So on the next page, we're going to start to produce the cost of goods manufactured schedule. So this is a formal report, so you need to have the company, the name of the report, and the period of time. So this is the report for the month ending August 31st. And we're going to start with the work in process at the beginning of the period. So that was $25,000. Next, we're going to list the three main product costs. So the first product cost is the direct materials. We have to calculate how much direct materials were used. So we start with the raw materials inventory we had on August 1st. So this is like we do the regular inventory changes. So we have the beginning raw materials inventory, the raw materials purchase. So this is that item we took out of that incorrectly produced income statement. So we added to our raw materials. So we have raw materials available for use. Subtract the raw materials we have at the end of the period, and that tells us how much of the raw materials were used for production of products. So we now have the amount of direct materials that were put into production. The next step, we need to add our direct labor. So the direct labor that was put, and we had this also on the income statement that was produced incorrectly. They told us that the wages paid to the factory workers were $160,000. So this is our second cost that goes into the inventory. And then our third cost will be the manufacturing overhead. And in this example, we have just the detail of what items went into manufacturing overhead. And so the way it's given to us, they told us that we had factory rent. They told us we had depreciation on factory equipment. They told us we had indirect labor. And then we calculated on the prior screen, it was 60% of the utilities and 70% of the insurance. So when we add that together, we had $124,500. So the total of these was $124,500. So we now can total the direct materials, direct labor, and overhead, and we come up with total manufacturing costs added to the work in process during the period of $489,000. So we're adding that to the beginning to get the total work in process cost during the period of $514,000. And then we're going to subtract from that the work in process at the end of the period, which is $21,000. And we were given on the prior screen the beginning and ending work in process amounts. That tells us the cost of the goods manufactured during the period is $493,000. So this is really just the basic inventory calculation. So this is the beginning inventory. This is the goods added. So this is goods added. So this is available. And this is at the ending. So this is sold, or this is cost of goods sold. Okay, so in this case, it's cost of goods manufactured. And those cost of goods manufactured end up going into another calculation like this, which is for the finished goods, and that tells us what the cost of goods sold actually are. So if we go to the next screen, when they're asking us to do our income statement, here's actually the cost of goods sold calculation. So our finished good inventory started at $40,000. We add the cost of goods manufactured that we just calculated on the prior screen, which gives us the cost of goods available for sale. The ending finished goods inventory is 52, so our cost of goods sold are 481. So if we take the cost of goods, so here, the sales minus, so we take sales minus the cost of goods sold, we get gross profit of $194,000. The expenses that we said were period costs, and this actually should be sitting here. So we take all the period costs, which are $200,500. We end up with a net loss of $6,500. Okay, so this is just an income statement, and instead of having all of those product costs listed here, we have the cost of goods sold number listed here.